Well, first, thank you to the organizers for including our paper on the program. This is joint work with my colleagues Pablo Cuba-Borda, Nils Gornemann, and Ignacio Presno, also from the Federal Reserve, and the usual disclaimer applies. So shifting gears, this is towards open economy, exchange rates, and also a little bit in terms of style, away from empirical, a little bit more towards theory. So now, what is this? What are we trying to do here? Okay, so this is a paper about exchange rate determination and how we actually think about this in various macro models and where do we stand and what we can actually, what we personally have to contribute to this conversation. So let me ease you in a little bit. So if you look at the macro literature, in most of the prevailing international macro models, there's a sense that they struggle really with explaining exchange rate dynamics. So there's a couple of puzzles out there that some of you may be familiar with from various days and stages in your career. So there's the so-called forward premium puzzle. This is a question about how well can interest rate differentials actually predict exchange rates. There's an excess volatility puzzle where exchange rates are highly volatile relative to other macro aggregates, in particular GDP and consumption. There's the so-called Backus-Smith puzzle, which is about the correlation of the exchange rate with cross-country consumption that most models get wrong. And so generally there's a sense that, then there's an issue about exchange rate forecastability. So this paper is mostly about the first three. The last one is not what we are sort of exploring today, but I think it also has implications for that here. So in a sense, there's a notion out there that exchange rates and the macro variables are disconnected also. What I've just said, you could take a glimpse from that. And so the way to address this, or one way of how this has been addressed in the literature, is to sort of think of, well, there's somehow some notions of macro shocks, being, say, to investment, consumption, and other kind of variables, other kind of shocks that we think about in macro settings that sort of are explaining more or less the macro variables and the international dimensions of that. And then there is sort of a financial or UIP shock that explains exchange rate, but doesn't really move anything else. And so most prominently, I think in recent years, this came out in this work by Itskoki and Muking in 2021. And the way they introduce and I want to think about is right now is, so at the bottom of the slide here, we have the UIP condition written as this is a change in the exchange rate relative to the change in relative to the interest rate differential. And so normally, so most models, this would be just equalized, but well, when you go to the data, that's not going to be the case. And so one way of reconciling then a lot of puzzles out there is by sticking in a shock in there into this UIP condition. And Oleg and Dima, they gave a nice interpretation to all of this and a lot of justification for this. So now what we are doing is we want to reconnect somehow some of these conversations. We are sort of moving back to sort of trying to find a fundamental shock that generally sort of has a potential to potentially affect more macro variables, but still resolves all of these various issues. And the approach we are taking is combining two elements in the international macro literature. So there's as on the one hand, it's going to feature importantly in here is what we're going to label a trade rebalancing shock. So it's a shock that changes sort of the demand for the domestically produced good relative to the foreign good. And this is a stylized way that I'm saying this. You can extend this to all sorts of things, including non-traded goods and other stories. But so the key thing is about shifting demand from imports away from imports to domestic goods, or the other way around, of course. And so things that can speak for this, just to give you some ideas, is stuff like tariffs, transportation costs, also preferences, and so on and so forth. But the other element that's going to feature very importantly in here is a notion of costly financial intermediation, something that limits sort of risk sharing beyond of what we typically have in these kind of macro models in terms of risk sharing. So we're moving a tiny little bit, not much, a tiny little bit more in a more financially constrained world than what we often have in the macro literature. And so what this does, it gives rise to a second wedge, a second element in this UIP condition. So we have on the one end, as you can see on the slide, and in green, this is again the original UIP shock, which is sort of an exogenous shock, and introduces an endogenous wedge in there. So this endogenous wedge it's this chi and times this b tilde, and I'm going to explain in a moment what they are. But as you can take from the coloring, so the chi is sort of governed by the strength of the restrictiveness in international financial risk sharing, and the yellow part, the B, is going to be tied to the trade balance. So that's kind of keeping track sort of trade deficits, past trade deficits in a manifestation through the net foreign asset position. That's this B in our case here. And so what I'm going to do for most of the part today is going to just take a very, very simple model in which I illustrate the story that we have. And, but in the paper, we have a quantitative estimated medium-scale DSG model and all these with the various bells and whistles, and things gonna go through. So hold on, that was the wrong direction. So what are the key findings within this setup? Well, not surprisingly, both the UIP shock, well, that was by construction in the previous literature, but also the rebalancing shock, I'm going to argue, they can sort of address these various puzzles. They speak sort of in a meaningful way to these puzzles that we have out there. So the forward premium puzzle, the Bucker-Smith puzzle, the exchange rate volatility puzzle. But what was going to be the key thing in here is, well, how do we distinguish then if some of these standard puzzles are both addressed by these two kind of shocks? How do we distinguish actually between these sources of fluctuation? And that's going to be where the trade balance itself is going to be very important to distinguish that. So the main finding is going to be that the rebalancing shock in our world end up explaining in the most complicated model, the estimated DSG model, that rebalancing ends up accounting for 50% of the variation in the real exchange rate, whereas the UIP shocks, who's important, have gone down to 15%. Whereas in other formulations in the past, if you leave out these rebalancing shocks, you actually would find that UIP shocks explain about close to 100% of the volatility of the real exchange rate. So now, let's go on here. Related literature. There's many people who have contributed to this. Giancarlo just joined. Is of course one of the people who contributed to that literature very prominently, but other people in the room as well. Don't want to spend too much time now on the literature, but just making sure that there is a connection also beyond the Skokie-Mukin work, and others have contributed to this work importantly. So now, what's the framework to give you a sense? So this is think about a very simple world. There are two countries. Each country consumes both the domestically produced and the foreign good. And this foreign good and the domestically produced good is produced just using labor. Households have preferences over consumption. This final aggregate consumption goods C, and they work for it labor. So here we have one simplicity that are gonna that eventually in the paper we generalize. So here you see that preferences are linear in labor. So, but you can ease that, and things are going through. It's just the algebra for parts of the paper where we show theorems is much easier this way. Now, the two key elements that are coming in is in the budget constraint. It's this second line on the second equation on the slide. And so the key element is there this phi 1 TB. So this is like a wedge. That's here we model this in a reduced form, but you can think about it in more complicated ways along the lines of Gabex and Maggiore, where there's sort of an international financial intermediation problem that's in there. But fundamentally, it's a wedge that sort of when you're a creditor, you receive a little bit of a lower interest rate, and if you're a debtor, you have to pay a little bit of a higher interest rate. That's fundamentally just the wedge that's coming in there. Okay, and the last equation is consumption aggregator. This is where our rebalancing shock is coming in. It's these omega weights that here we just take really these shocks to these omegas as literally the shocks to that. But again, as said, so you can think about more complicated versions of driving this, and there's parts in the paper where we end up doing that. All right, so one last element I want to say on these shocks. Well, so they can be mapped in a lot of things. There's a longer tradition starting with Mundell, And again, so you can even think about this, about non-traded goods included in there, which is sort of the same sense that you're just moving away from. So one type of good that's coming from abroad to whatever is produced domestically. Now, just one key definition. So in this very simple model I have here, so when I say have this delta there, that's the terms of trade in the model. And these terms of trade are actually going to be proportional to the real exchange rate, to the Q. So whenever you see me saying delta goes up or down, that you can also think about Q going up or down. And the notation that I'm following here, if Q goes up, so that's a depreciation of the exchange rate, and if Q goes down, that's an appreciation of the real exchange rate. Now, briefly on these financial intermediation costs. So here we took sort of a very dirty shortcut. This goes back to the works of Tarnowski, actually. So we specified some sort of financial intermediation costs back in, I think it was in the 80s. But it's in the reduced form, it's going to look exactly what the reduced form of Gabexa Major is going to look like. So in this regard, pardon our shortcut here. So why do I drag you through all of this? Well, because you actually can summarize this model very neatly in just 3 equations in terms of the dynamics and how you can play through the intuition that's going on. And so those 3 equations are, well, one candidate, the first one you've already seen a little bit. That's just a generalized UIP condition. So we have on the left-hand side changes in the terms of trade. And then on the right-hand side, there's differentials on how country-specific technology evolves. So those are those Z's. And then you have these 2 protagonists in here. So the endogenous UIP deviations. So it's the chi interacting with the NFA position, so the B, sorry. And you have the UIP shock itself in there. Then we have the trade balance, which depends on the shift in these relative in these relative tastes. So the side trade, this is just these are the shifters for these omega weights, and how they also depend then on the trade on the terms of trade. And then the last one is just the evolution of the NFA position. Now let me just briefly show you of how what we derive from there. And so that's sort of the key theorem, and what we have is in the paper is that, well, if we look at if we condition on shocks both to the UIP and the rebalancing shock, so if we condition on those shocks inducing a real exchange rate appreciation, so then you find here differentiation how these things impact the economy. So the UIP shock leads to a deterioration of the trade balance, versus the rebalancing shock causing an improvement of the trade balance. I'll show this in a second through the equations that we had. Now, the second element that you have is this chi, this financial intermediation issue. So the higher you make this chi, so the more you move away from an incomplete markets economy and a tiny little bit away from that standard formulation, and restrict a little bit the ability to smooth shocks through the trade balance, that's going to amplify the impact that the rebalancing shock has on the real exchange rate, but it dampens the effects of the UIP shock on the real exchange rate. For both shocks, though, so the higher chi dampens the trade balance movement. And so the way you can easily see this is in this is here through the system of equations. So if you look at the UIP shock, so it shows up only in the top right of the UIP condition. So if that shock goes up, so then what that means, you expect in the future a deterioration of the terms of trade. So you must have seen on impact an improvement of the terms of trade, or an appreciation, real appreciation of the exchange rate. So that means this delta has to go down. So that's equation 1. So if you just naively go through the various equations, so delta has gone down. So you go to the second equation, the trade balance. Well, that means the trade balance must have gone down. And if the trade balance must have gone down, then the net foreign asset position must have deteriorated. That's from the third equation. So in that regard, this shouldn't surprise you, given of what I've said earlier. And now you get a dampening effect, though, if you go back and say, well, Martin, you forgot that some of these variables show up, of course, in many equations. So if you jump back to the first equation, the UIP relationship, then you have this chi interacted with this NFA position, so you get this dampening effect. Because now the B has gone down, the chi is some small positive number, so you have a little bit of a dampening effect that the UIP shock must have had to start with on the terms of trade. So that's illustrating the second part of the theorem we had. Now, the rebalancing shock, actually operates primarily not through the UIP, but it primarily works through the trade balance side. And then, so if you have sort of people shifting away from imports and towards domestically produced goods, then so if that shock goes up, so the trade balance goes up. Starting from the trade balance, you have the NFA position is improving. Now, with the NFA position having improved, hop to the UIP equation, the first one. So what you're going to see, so it's the end, again, the interaction with the chi. So the chi and the B interact. So now this works towards a real exchange rate appreciation in a similar way when the right-hand side goes up as explained earlier. And so now, though, with the terms of trade having improved, you get a dampening effect in the trade balance condition, because now, of course, with delta having gone down, you get something that pulls the trade balance in the opposite direction than the original shock. But it's not going to be big enough, so that's why it's a secondary effect. Now, the other thing we show is, and I'm not going to spend too much time on it, is that we show analytically that at least for this very simplified model, and then for more complicated versions of the model, we show it numerically, is that both of these shocks, the UIP and the rebalancing, they're gonna check off these other three puzzles that I introduced earlier. So both of these shocks, they end up leading to a lot of movement in the exchange rate and very little movement in consumption or GDP. They both introduce this Backus-Smith type correlation, so where consumption in the country goes up, that actually sees its exchange rate appreciating, which is something that often you don't see in a lot of macro models. And then when you look at the pharma regression, so this is about the UIP puzzle itself, you're going to find that this correlation is actually negative in our model, where often in standard models it ends up being positive and equal to 1. So I'm going to jump over these and just kind of come to a quantification a little bit. So far, I've just given you some theory. So now it's the question, what can this little model actually do? How successful can this already be in terms of distinguishing between these two type of shocks? And to do so, we go to a bunch of data moments that are featured prominently in the literature, and sort of try to sort of estimate try to sort of pin down a very small set of parameters that we have and see whether we can, to what extent can we match these moments. And the key thing we're going to do in here, so we fix everything else. The only things we're trying to move around here is now the sky, so which is the hero of our story here, and the standard deviations of the shocks to match a bunch of moments here. So it's the autocorrelation of the NFA. It's the relative volatility of the real exchange rate to GDP. We're going to look at the persistence of the real exchange rate. We're going to look at the volatility of the trade balance relative to the real exchange rate and the correlation between those two. And so I'm not going to. So fundamentally, what I'm going to convincing you here first in this table quickly is, well, we're going to able to match this now, but why and how do we match this? And so this is probably more helpful to go to this graph here. So what we're plotting here, we're plotting here the data moments is these thinner red lines, and I want you to focus on those blue lines, which is sort of the full model, and it sort of shows you how do the moments in the model change as you move around this chi, so the strength of international financial intermediation channel that we have. And so what you can generally tell is if you don't have this chi in there, then these blue lines are quite far off, these thin red lines. So so you're missing on a lot of important elements. Now you bring up this chi a little bit. So eventually you sort of hit very well most of the moments, except for the two in the bottom left part. But I don't want to spend too much time on it right now. But it doesn't certainly do worse than a model, which is the alternative model I'm plotting in here. So one with these red dashed lines, in which I've stripped out completely the story of the rebalancing shock by just removing it from the model, where the model does do miserably on a lot of dimensions. So a key thing is, in particular, when you look at the bottom right, so if you look at the trade balance and real exchange rate moments, so you definitely need another element in this model in order to fix that. Now, is the straight rebalancing shock the only one that can do this? Probably not, because you have always in any, this is a very simple model with just 3 types of shocks. So the more shocks you have, the more you do. The more you're able, of course, of addressing certain puzzles. But the interesting thing is that in this context, not only do you, with this straight rebalancing shocks, and the slightly higher chi, not only do you match so these trade balance real exchange rate moments, but you also simultaneously do very well on a lot of these other moments that we talked about earlier, in particular the real exchange rate volatility. And so, to give you a sense of how important this moving around of this chi is and how this affects the variance decomposition of the real exchange rate. So that's this chart here. So on the left, we plot the variance that's attributed to the rebalancing shock as a function of the chi, and the right one is the exchange rate variance that's attributed to the UIP shock as you move around the chi. And so when you shut down this channel, so this limited so these limits to international financial intermediation and put the chi down to 0, then the channel for our model just collapses, it disappears. There's nothing to be said for trade rebalancing shocks as a driver of the exchange rate, and everything goes to the UIP shock. Okay. When you, however, sort of allow for a little bit of this friction, you see very quickly picking out the UIP shock declining in its importance, and the trade rebalancing shock gaining a lot of more into prominence. It's very consistent with what I started out arguing in Theorem 1 of how the interaction of the chi with the importance of the shocks plays out. So then there's a lot of sensitivity and robustness and extensions in the paper to sort of make sure that this is not just specific to the formulation that we had. As I mentioned, most of those things under the first item already. Let me sort of jump to 2 points that sort of have been sort of important. So one is, so the alternative explanation to the Skokie-Mucking work, but also to our work, is the work by Keckler and Nils, so who went to discount factor shocks as a source of explaining the volatility in the real exchange rate. Now, so we can have long conversations about this. I think the key point I want to convince you of here is that the way that discount factor shock, so this is shock to the beta basically in the utility function of the household, so with how much they discount the future, it's isomorph in this formulation in these 3 equations. At least it's isomorph with the UIP shock. There's some other dimensions where it's not isomorph with the UIP shock, and that's actually pertains then to the forward premium puzzle, where the Keckler-Nils shock actually is gonna say that it's actually pushed more towards against the evidence in the forward premium puzzle, and would suddenly suggest much more as interest rate differential as part of explaining exchange rate. So there they push it more towards 1 actually in that world. But so in this 3 equations, it's isomorph. So in particular, because it's isomorph, it's not going to say anything new about the trade balance relative to the UIP shock. So it's going to have the same pathologies as the UIP shock in this world. Now, the other shock, the other dimension I briefly wanted to point is the labor supply, because I had it linearly. So now we introduce a different labor supply, so where we allow the labor supply to be somewhat less elastic, less than fully elastic. So you may wonder, well, in that case, you have a richer interaction. So the relative consumption differential is no longer just proportional to the terms of trade, as it is in the case when when labor is fully elastic. So you get a feedback mechanism from the trade balance into this relative consumption part. But that's not going to overturn the Backus-Smith finding or other elements to this regard. So this is just the picture to just, we've done it, it works out, so it's not, it shouldn't be a biggest concern. Now, very, very briefly, before I'm ending, So let me end on giving you a quick sense of the DSG model. So DSG model is, again, so it's the core block is what I just described, and then we enrich it with the usual bells and whistles. We estimate it using time series data, time series data, and so we do an exercise in which we try to figure out, well, if we fix the chi and then estimate the model for every chi nu again, where would the log data density peak? And as you can see, so it's going to peak here on the left side, where I have the full model. It's going to peak sort of on the interior, where the chi is actually positive. And if I throw out the whole trait complex, then the chi that the model wants is actually very much to the left. And here I should stop and hand it over to Gernot.
Thank you. So the paper will be discussed by Gernot Müller from the University of Tübingen.
Okay, thanks a lot for giving me the opportunity to discuss the paper. I read it. It was a great pleasure. It's very well written. And I think it makes an important contribution to the recent literature on the disconnect. So here's some context. I mean, there is the very influential work by Itzkoki-Mukin. And the point here being that you have all these puzzles in international macro and finance. You have excess volatility of the exchange rate. You have Fama, you have Baker-Smith, you have Misi-Rogoff. And all these puzzles, they show can be explained within a fairly standard international business cycle model once you assume that international financial markets are segmented and you add this single shock to the UIP condition. So that's the story. So I think this paper was quite influential in the last couple of years and has, shaken the field, I would say. And it has also triggered, of course, some follow-up work. And I think the next paper in the list here is this Kekre and NL paper, which Martin also mentioned. So their point is that these UIP shocks are all fine, except that they induce the wrong co-movement between the level of the real exchange rate and interest rate differentials. And so their take is you need more shocks, you need other shocks, namely persistent shocks to preferences to get the full picture right. So this is where Martin's paper comes in, the BCGP. And so they make a similar point. So they say, well, UIP shocks are good and fine, except that they induce a positive co-movement between the real exchange rate and the trade balance. So positive co-movement means here these UIP shocks appreciate the real exchange rate. It goes down. They also lower the trade balance, and you get a positive co-movement. While in the data, the two guys are unrelated contemporaneously. You see the correlation here is 0. And for me, Martin said, the chi is the hero of the story. For me, this is the hero of the story. Yeah? So this 0 co-movement between the thing. Because you think, okay, the co-movement between trade and exchange rate, that should be part of the story. We cannot leave that out. Yeah, and so this is where the rebalancing shocks come in, because these shocks, they induce the opposite co-movement, offsetting what the UIP shocks get wrong, because they induce this a negative co-movement. And as Martin explained, this is no small feat, because that only works to the extent that you keep these international financial markets segmented, so that you need the chi, otherwise you would screw up the other moment. So it's not that simple, but the paper is very well written and the mechanism is well explained, and I think the authors have a strong case. So against this background, I want to take to this look at this hero again. So the correlation between the trade balance and the real exchange rate. So that's for the US here, so in blue the trade balance and the real exchange rate as defined in Martin's paper, so it goes down, you have an appreciation. And indeed, if you stare at this picture, you'll see that contemporaneous correlation is maybe 0. You can assess this more systematically, also not only contemporaneously, but as I do here for lags and leads. So here we're looking at the correlation of the trade balance, from minus 8 quarters back in time to 8 quarters forward in time. And then you see indeed, so that's the paper, the BCGP. So there's 0 contemporaneous correlation. But then if you look a little bit more into the future, you see this positive association coming up. So that means that if you have a weaker exchange rate today, that is associated down the road with a trade surplus. That's how these variables are defined. It's a bit mind-boggling, of course, but we are used to that. Yeah? So but some of you may be reminded of the classic Bacchus-Kitland paper. This is where I started with Giancarlo working on international macro like some 25 years ago. So they try to establish this, what they call the S-curve as a stylized fact, and they look at the terms of trade, which in this model is the same as the real exchange rate. And indeed, they show that for all countries they consider, you have this S-curve pattern. So contemporaneous correlation is negative or 0 for the US, yeah, mildly positive, just like in the figure I showed you. And then you go forward in time and that correlation turns positive. Now, I should say BKK, they do this in the context of a J-curve and are interested in, this association, exchange rate and trade balances. But of course, they want to use this to push the RBC model, and they account for the S-curve pattern in their model only through TFP shocks. TFP shocks in their model depreciate the terms of trade, but they also induce an investment boom, which triggers a trade deficit, which is only later reverted, and that gives you the S-curve pattern in the data. Yeah? So I think that's good news for Martin here, because in their model, my hunch is that the rebalancing shock can also speak to the S-curve. Contemporaneously, you get this negative correlation, but then by staring at his impulse response function, I figured over time you get towards a positive co-movement. So bottom line is, with the rebalancing shock, you should also be able to account for the S-curve, and therefore consider a richer set of moments, which with UIP shocks, in the model, it seems that they also predict the wrong kind of co-movement here over time. So bottom line being a stronger case for rebalancing shocks still. Yeah? So that's good news, but there's a downside to it, I would say, if you pursue this. And the downside is, what I would say, you stay within what I would call the game of moments, or say more specifically, the game of unconditional moments. What's that game? So the way I think about it is I watched the 8 seasons in order to prepare this presentation here. But so you have this iron throne of moments where you have some unconditional, that's the key point, some unconditional business cycle statistics. In our case, the star, the hero of the show being like the 0 correlation between the trade balance and the real exchange rate. Yeah? And then you have the shocks making the claim for the throne. So here you have Itzkoki Mukin, the UIP shock. Here's Kerker Nenel, and here's Martin, rebalancing shock. And they claim this throne. I mean, this is a fun game to play, intellectual, very exciting. But the bottom line is, to the extent that we treat these shocks as unobservable, this game never ends. Yeah? So there's always new shocks coming up and entering the show, which we may enjoy. Yeah? But we can also try to be a little bit more ambitious and move beyond these unconditional moments. Yeah? And I think there's a precedent for that. The precedent, Gali's 99 AER piece, where he argues that he puts forward direct evidence for the transmission of specific shocks. You may remember, like in the decade prior to that paper, the literature has been put forward additional shocks or added shocks to the RBC model in order to make it match the unconditional correlation between output and hours. One example being Cristiano Eichenbaum adding government spending shocks. But then Gali finds, by looking directly at these TFP shocks, that they lower hours, and so that speaks directly against the fundamental transmission mechanism in the RBC model. So for me, the upshot is, of course, you can bring 2 shocks together to get the unconditional moment right, while both shocks give you the wrong transmission mechanism. So can we learn something for the disconnect debate? I think, yes, we should try and move forward and establish direct evidence for specific shock transmission, rather than looking at the second unconditional moments. Of course, we are not naive. There's no free lunch. Then the cost is identification troubles. But I think Martin, in their paper, they explain nicely that this rebalancing shock can be thought of as either tariff shock, transportation cost shock, or preference shocks. So these we can partly observe, I would think. Yeah? So what I do here then, in the remainder of this discussion, I pull a measure of UIP shocks from a recent paper by Alan, or rather I got it from Jorgo. I give him credit even though he's missing right now, but okay. So I take his UIP shock, which is reconstructed the Allen series, and I take, as a measure for the rebalancing shock, I take the transitory tariff shocks identified in a recent paper by Schmidt-Grohe and Uribe. And then I run some local projections where I look at these variables which are interesting me here. So that's the real exchange rate and the trade balance, how they respond to these shocks. Okay, and this is what I get. So the top panels, let's focus on the top panels for a second. So this is the response to the UIP shock. Yeah? Trade balance left, real exchange rate right. The real exchange rate appreciates as the model says it should do. Yeah? So here you get this positive co-movement. Trade balance deteriorates, real exchange rate appreciates in response to UIP shock. So that's all fine, confirming directly the transmission mechanism built into the model. Yeah? Bottom panels give you the response to a tariff shock. Yeah? And here you see, again, consistent with what the model predicts, that the trade balance goes up in response to that rebalancing shock. But the real exchange rate is not appreciating as the model predicts it should. Yeah? So in this sense, in response to the tariff shocks, we don't get the kind of negative co-movement which in Martin's account we should have in the model in order to offset the positive co-movement which we get from the UIP shock to get overall to the zero correlation. Yeah? So bottom line, I think we should look at, try to come up with direct evidence. And for the UIP shock, it kind of works here according to my estimates. For the tariff shocks, it doesn't seem to add up. Yeah? But I think there's a way forward because, you know, you may try other rebalancing shocks, yeah, for instance, transport shocks. But I think what's important is we should be a little bit more ambitious, establish direct evidence rather than, you know, playing this game of unconditional moments with unobserved shocks doing all the heavy lifting. Yeah? Summing up, I think it's an important paper because it brings the correlation of the trade balance and the real exchange rate back into focus. And this is where it belongs if we talk about exchange rate. We are concerned about trade, apparently, these days. So my hunch is we are not done with the exchange rate disconnect yet. Thanks.
Thank you. Martin, would you like to quickly respond?
Yes. So first was very much appreciate the comments, Gernot. Thank you so much also for watching TV in order to come up with the game, the throne of moments. No, so points very well taken. I think so we thought a little bit when we went to the DSG model estimation that was a little bit our shortcut, our dirty way of thinking more about establishing more direct evidence, but fundamentally it still lacks the kind of finesse that you did in the local projections, and probably going to be in touch more about what exactly you did there and how to sort of read and understand some of that, because there was a little bit of a promising part. So, I mean, it wasn't significant in your LP project in your local projections, but on impact there was a very tiny appreciation of the exchange. So we'll look into that a little bit more, but also look at other measures. And I've also recently come across other measures of sort of any kind of trade friction. So I think this is a very worthwhile path to continue, because you're totally right. So you can always try to play this game, but I think it was somewhere in the context of some of the conversations yesterday as well. I think you can amp up the game constantly, and eventually you don't really know sort of. You have many things going on, and then you lose a little bit sight. So establishing direct evidence is very much appreciated. So on the I also like the comment though about the trade balance and the interaction and the sort of the lead lags with the exchange rate. So that's something we can easily do. I think that probably the estimated DSG model takes some of that already on board because it uses all the data. But yeah, that's something to check a little bit out more. But I think you're right, so that the model actually should be able to speak to that already, even in its simplest form. But yeah, thank you again for taking the time and very insightful comments.
Thank you. Then let me open the floor.
Well, thank you for this very nice presentation and discussion. And I have a basic question. So, as we know, as part of the effects of this trade rebalancing shocks may heavily depend on our assumptions about elasticity of import and exports. And we know that these elasticities may also depend on, may change over time, or they may depend on other choices that we make into the model. So, whether a model at the end is able to capture the correlations heavily depends on the specific assumptions we make about those elements, and how should we think about it.
Kite?
I think this is Kite Küster, University of Bonn. That's probably a weird comment to some extent. Certainly it is. Now, the question is, you have these international puzzles, and you have precedent in literature for what you're doing. On the other hand, people who haven't read the previous literature may think of the exercise as you going on a fishing expedition, just throwing in certain elements and see what works. So why not throw in other elements and see what works, and try to build then more micro-founded theory for why these elements do work in UIP deviations? No, it's a question on the intellectually what we get from the exercise.
So I would have an additional question regarding the role of the financial intermediation element. So this is, of course, also then implicitly providing very strong restrictions, so that, say, the net foreign asset position is stationary. And the model then, of course, requires exchange rate adjustment to return to the net foreign asset position. Now, in reality, we see huge and long-lasting deviations from stationary net foreign asset position. So, and I was wondering, whether one, in the end, wouldn't need to rely also on an element of saving investment imbalances that are then ultimately driving then, say, also then the net foreign asset position. So it's basically the importance of the domestic imbalance that is also then having an important impact. So that's at least one thread of the discussions which are now held at the G7 level.
All right, so we're gonna, in the interest of wrapping up also the session. So, well, first, thank you for the comments. So, on Davide's point, so we did look at some time variation in the elasticities. We played around also with the elasticities themselves. So I think fundamentally we ended up, well, there are two pieces that inform us. So on the one hand, just generally the macro literature, and so we took guidance when in the first part when we more calibrated the model of what sort of standard views there in the macro at the business cycle frequency. So it was sort of like something between, I think it was 1.5 or something like this. We took as an elasticity between domestic and foreign goods, in the estimation, so we opened that up and let the data speak more to what is that number, but also introduce some time variation through some import adjustment costs, so that you had some of that. But yes, but I think fundamentally there is an issue about the international transmission and what is the role of the elasticity, and which goes a little bit, I think, also towards Kite's point. So the question, so you have puzzles and you throw a lot of things in there and you try, how do you address that? So I think the way we try to address this, I think when we go to the DSG model, where we open up more dimensions, more things that can compete with the explanation. And I think the key explanation comes out over and over again, regardless of how we contort and then kick the tires on it, the model just really wants to have these trade rebalancing shocks, and it wants to have the sky sort of being somewhat tucked away from zero. I think that is that's one attempt of trying to do that. This is not to say that building up from the bottom and with more micro-based theories one can do more, but that's just, I think, another approach of doing about that. So to Günther, so we haven't really, so it's about global imbalances. I mean, that's one of the topics of the day. So the model does have some implications for that. I think we're not focusing on that, but you do get, of course, lasting departures here. The NFA positions are quite persistent, so you do get sort of some of these situations where one country is for a long time sort of indebted versus the other one. We can open this also up for having some more persistent changes in the original trade balance. So we haven't pursued that for this specific question for the exchange, because fundamentally we're looking here at a, not like super high frequency, but still like quarterly stuff. But I think for some more persistent, longer ones, I think the model has something to say, but we haven't really explored that yet. But I think it should be reasonably easy, given that we have the estimated DHE model and where we have capital and investment in it, and so we could at least talk about some of these dynamics. These are not all the elements that are relevant for the discussions on global imbalances, but at least somewhat in that direction. So we should be able to speak more to that. Thank you.
Thank you. Then let us provide a final applause before closing the session.